All right, in this video, I'm going to do a member request. One of our VIP Discord level members, Big Tuna, requested that I evaluate Grab Holdings stock and answer what I think about the company. And it's an interesting request because I haven't visited Grab stock since March of this year when I rated the stock as a buy. I think it was March 7th precisely when I last updated this company and rated the stock as a buy. So in this video, I'm going to revisit Grab Holdings, look at the company's latest quarterly earnings results. And today I also updated my discounted cash flow valuation model for Grab Holdings. And I'll share with you my updated proprietary DCF valuation and look at valuation on a forward price to earnings ratio, and then determine whether or not I still think this stock is a buy or if I'm downgrading it to a hold or a sell. So thank you again for your request, and let's jump into the details.
I want to thank The Motley Fool for sponsoring this video. Visit fool.com/Parkev for the 10 best stocks to buy now.
Right, so Grab Holdings last updated investors on July 31st, 2025, when it noted that it now has over 46 million monthly transacting users. Furthermore, gross merchandise value on the platform accelerated to 21% year-over-year growth, and the company delivered its 14th consecutive quarter of adjusted EBITDA growth. They also strengthened their balance sheet with a $1.5 billion zero-coupon convertible senior note. And let me explain what this is, because it's kind of a advanced product, I would say, in terms of financial products go. A zero coupon convertible note is a bond that the company issues. So Grab Holdings will get $1.5 billion, and the lender will get this bond that does not pay a coupon, no annual or biannual interest rates, but they will experience an increase in the price of the bond. So they'll get a capital gain on the bond. And then they also have the option to convert that bond into shares of the company. So if the company's stock price improves meaningfully to the level that's agreed upon in this agreement, they will convert this bond issue into shares of the stock. In that scenario, that $1.5 billion of debt will be wiped and it will be converted into shares of the company. So it will issue additional shares, and that has the potential of diluting shareholders, but it will be converting the notes to an equity. So this is like in the middle of debt and equity when you're issuing a convertible bond. So the group number of monthly users increased to 46.2 million. That was up from 41 million in the same time last year, an increase of 13%. The cash flows from operations declined meaningfully by 77% to 64 million, down from 272 million. But as I dug deeper into this, the reasons for the decline were not alarming. The reasons for the decline was because of an increase in the number of borrowers. Remember, Grab Holdings also has a financial services segment in addition to its ride sharing and food delivery segment. So the financial services segment gives out loans and takes in deposits. And in the quarter, it gave out a lot more in loans and took in a lot more in deposits, but not enough to offset the increase in loans. Operating profit in its second quarter came in at 7 million, which was an improvement of 63 million year over year, driven by increases in revenue, improved margins, and disciplined cost management. And the whole industry, the food delivery and ride sharing industry worldwide, the competitiveness of the industry has improved for investors. A few years ago, this was an intensely competitive industry that was doling out way too many incentives for both drivers and customers. It was not uncommon for me to get an email from all of the various food delivery and food delivery, especially companies offering me, 75% off my order of $20 or more, or $15 off my order of $20 or more. And I would get these regularly from all of the various companies, so I rarely had to pay very much for ordering a meal for delivery, those have since pretty much diminished. I've not seen very many of those. And when I'm evaluating the balance sheets and the income statements of companies like Uber and DoorDash and others, I'm seeing a significant decrease in incentives, and the management teams have talked about decreasing incentives significantly, and that's good news for investors. As I mentioned, the company said that lower cash inflows from deposits from customers in the banking business and higher cash outflows related to their lending business was the cause of the decrease in the cash flows from operations. These are timing issues, and I expect that will reverse going forward. The company's core operations improved meaningfully. Looking ahead, the company expects the good performance to continue, forecasting revenue growth for the fiscal year 2025 of about 21% at the midpoint, with adjusted profitability coming in at 50% increase year over year. Those are solid increases for Grab Holdings. So now that we looked at the latest quarterly performance, let me share with you my proprietary discounted cash flow valuation model, where I calculate a fair value for the stock. So I updated this cash flow forecast and valuation today, and the value increased by $1.50. So previous to today, I had the intrinsic value per share calculated at $5.40. And since updating my spreadsheet, I increased the calculation to $6.93. And the primary difference between what I had valued yesterday and what I valued today, or what I updated this morning, was the company's free cash flow expectations between 2025 and 2035. I revised them upwards based on the Wall Street analyst estimates of the company's free cash flow expectations. I revised them upwards by about 10 million per year between 2025 and 2035. And that revised outlook increased the intrinsic value per share. So I now calculate the business to be worth $6.93. Current market price is $5.03, signaling that it's undervalued using my proprietary DCF formula. Now, when I go to fiscal.ai, which is my preferred data source, and I retrieve the forward price to earnings ratio, which is another way I like to look at valuation, it's trading at the cheapest valuation it's been all year long, is trading at a forward PE of 55. And given that it's increasing revenue by 20%, increasing monthly active users by over double digits, and the company increasing profitability 50% over year, and it has a massive total addressable market opportunity, I think a forward PE of 55 is undervalued for this stock. So to update my recommendation, as I mentioned, I had last visited the company on March 7th, and today I will update this buy rating. I still think this company is a buy. I like the prospects, the valuation, the industry. It looks good to me. Of course, higher than usual risk. This is an above average risk company, but I like the risk versus return. Again, thank you, Big Tuna, VIP Discord member, for requesting this video that everyone gets to benefit from.
Hey everyone, I'm excited to announce that my book, Make Money Buying and Selling Stocks, a 6-step framework for evaluating publicly traded companies, is finally available for sale. Unlock the power of intelligent investing with my 6-step investing framework. It's a proven system designed by a university professor and a chartered financial analyst. Frustrated by the lack of frameworks that met my needs and high standards, I developed this comprehensive guide to help investors at all levels make confident and informed decisions. In this book, you learn how to assess opportunities, manage risk, and build a portfolio that works for you. No investor should dive into the market without a solid strategy, and this step-by-step framework provides you the roadmap you need. Whether you're just starting out or looking to refine your approach, this guide will empower you to take control of your financial future. I've added the link in the description below.